In 1970, the average American home cost about 2.5 times the average annual income. Today, in many cities, it's 6, 8, sometimes 10 times. Did houses get 3 times better? Did land suddenly become gold-plated? Or is something else quietly pushing prices up year after year, no matter who's in office, no matter what the headlines say? Because here's the uncomfortable truth. Housing prices don't just rise because people really want homes. They rise because the system is designed to make them rise. And once you see how the machine works, it's hard to unsee it. Right now, housing feels impossible. Rents are high. Mortgage rates jumped. Young buyers feel locked out. Older owners feel rich on paper. Politicians blame investors. Investors blame supply. Everyone blames everyone. But underneath the noise, there's a very specific financial engine at work. Let's start with something simple. Most people don't buy houses with money. They buy houses with debt. That sounds obvious, but it's more important than it seems. In the US, the 30-year fixed mortgage became dominant after World War II. That single innovation changed everything. It allowed buyers to stretch payments across 3 decades. Suddenly, homes didn't have to be affordable in cash. They only had to be affordable per month. And monthly affordability depends on one thing more than anything else: interest rates. When rates fall, monthly payments fall, even if the home price rises. Here's the trick. If rates drop from 8% to 4%, a buyer can afford dramatically more house for the same monthly payment. Sellers notice. Prices adjust upward. What started as cheaper borrowing turns into more expensive houses. Over the last 40 years, interest rates have mostly fallen. In the early 1980s, mortgage rates were above 15%. By 2020, they were below 3%. That wasn't just a small shift, it was a generational tailwind. As borrowing got cheaper and cheaper, buyers could bid more and more without feeling the pain immediately, because the pain was spread across 30 years. Debt became fuel. But that's only the first layer. The second layer is supply, or more accurately, the restriction of supply. In many major cities, zoning laws limit density, height limits, parking requirements, lengthy permits. It can take years to build new housing. Meanwhile, populations grow. Jobs concentrate in specific metro areas. Demand piles into limited number of neighborhoods. When you mix easy credit with tight supply, prices don't just rise, they accelerate. Then comes the third layer. Housing isn't just shelter anymore, it's collateral. Banks use homes as security for loans. Homeowners borrow against rising equity. Pension funds invest in mortgage-backed securities. Global investors park money in real estate for safety. Homes became financial assets woven into the entire system. When prices rise, homeowners feel wealthier. They spend more. That boosts the economy. Rising home values support more borrowing, which supports more spending. It's a feedback loop. And no politician wants to be the one to break it. Now here's where it gets ironic. We publicly talk about affordable housing, but privately, most voters are homeowners. And homeowners benefit when prices go up. Rising prices are politically painful for buyers, but politically rewarding for owners. So policies often do just enough to sound helpful, but not enough to truly flood the market with supply or reset valuations. Because a serious drop in housing prices wouldn't just hurt investors, it would hit middle-class balance sheets. It would weaken banks. It would shrink consumer spending. It could trigger a recession. Housing is too connected to fail easily. That doesn't mean prices only go up. We saw what happened in 2008, when credit expanded recklessly. No-doc loans, subprime mortgages, complex securities. The system cracked. Prices fell. Millions lost homes. Banks nearly collapsed. But notice what happened after. Interest rates were cut to near zero. The Federal Reserve bought mortgage-backed securities. Credit was stabilized. Prices recovered, and then kept climbing. The machine was repaired. Now, in the 2020s, rates have risen again. Monthly payments spiked. Affordability is near historic lows. Yet prices